15-year mortgage or a 30-year mortgage? Which one should you choose? So depending on who you ask, you're going to get many different answers. You ask 10 different lenders, you'll probably get 8 to 10 different answers. Ask 10 real estate agents, you'll probably get 8 to 10 different answers as well. Throw in a couple finance guys, they'll give you some different answers as well. So what we want to do is we want to actually break this down based on pros and cons, and then use a real life situation on how this could affect you today, tomorrow, and moving forward, and how long you're going to stay in that home. So before we get there, my name's Kinn. I've been in real estate for 21 years in the DFW Metroplex, and I'd love to help you with your next home buying transaction, or if you're looking to sell, we excel at that as well. So let's dive into the 15-year versus 30-year mortgage. Now, what we're going to do is we're going to throw up some pros on the 15-year mortgage over here and the 30-year mortgage over here. So the first pro with a 15-year mortgage is you're going to pay an interest rate that's much lower. Now, much lower is up to you, but typically they run anywhere from 0.5% cheaper to a full percent cheaper. According to Bank of America today, the 15-year mortgage was actually 0.75% cheaper at basically 6% versus 6.75% on the 30-year note. So that's the first pro for going with the 15-year. The second pro is you're going to pay off the home in 15 years. No matter what you do, if you don't add extra principal payments and you just make your payment, you stay in that home, or you buy an investment property and you rent that home out for 15 years, you now own it free and clear. So that's a huge pro. The third one is you're going to build equity much, much faster with a 15-year mortgage. The 30-year mortgage actually takes quite a bit of time, and you're more market dependent, that the market increases in price versus just paying off your note faster. So that's a big pro for the 15-year. Now, one of the big pros for the 30-year mortgage is a lower payment. So you're talking a much lower payment with that 0.75% interest. It may not seem like it because 0.75% doesn't sound like much, but when you extrapolate that out an extra 15 years, it means the payment is much lower. Also, one of the other big pros to choosing a 30-year mortgage is you can actually purchase more property with it. So in a typical scenario, let's say you were looking at buying a $400,000 home and you qualify under a 15-year, you could probably qualify more for like a 550 with a 30-year, simply because your debt to income ratios would be lower on that 30-year payment. Now, should you go up in price? Maybe not. But it is something that you could do. The other thing that we look at with one of the big things in a pro on a 30-year is you're more comfortable with that payment. So you can apply extra principal payments and try to bite down some of that principal if you would like, or you don't have to. So that payment is usually much more comfortable for people. Now, when we talk about cons on the 15-year mortgage, why do people not choose them? One, the monthly payment is significantly higher. You're talking again, 0.75% interest rate, that's going to pop your payments up quite a bit. And you're committed to that. So let's say you get into something like unforeseen incidents, like a job loss, or somebody, if it's a rental property, trashes your property. There's no stepping back that payment. That payment is there, and it's going to be there for 15 years. And the second one kind of relates with what we just talked about, the 30-year mortgage, is you can actually afford less house. So if you can afford less house, that's less of an asset. Maybe you want a bigger mortgage and a bigger home, so it actually fits your family better. Sometimes you can't do that in the 15-year market, especially with the way that home prices have taken off over the last couple of years. Now, some of the cons with the 30-year mortgage is you're going to pay substantially more interest over the course of that loan. By substantially more, we'll get into what substantially more means here in just a second. But the equity is actually very slow to build because all loans are front loaded with interest. So this is really good for the bank, really bad for you, the buyer. So if you look at the amortization chart that will pop up here on the screen, the 30-year fixed loan, you're only paying $2,919 towards your principal the entire first year that you own the mortgage. That is pretty atrocious. And we'll get into the exact numbers of how we figured this out and what kind of loan this is in just one second. But in the 15-year note, you actually pay $10,100 towards principal the very first year of mortgage. And by the time you're 6 years from now, you've paid over $109,000 towards your principal payoff. That same can't be said in the 30-year fix, as you're at $31,000 in principal payoff. So again, what's the trade-off here? So we're going to use a real-world example here of a $400,000 home. The reason we're using a $400,000 home is that's the average price of a home here in Tarrant County. Let's say you're really good and you have a 20% down payment, just to make numbers easy, so we don't have to get into adding in private mortgage insurance or MIP or any of that stuff. So we're going to stick with a 20% down payment, so that means you're financing $320,000. On the 30-year fixed at 6.75%, that payment would be $2,075. On the 15-year at 6%, that payment would be $2,700. So it's a $625 more every single month that you're going to have to make towards your payment. Now, some of you are probably thinking $625, I can handle that. But again, you have to think of things as they pop up. If a life event happens, can you still handle that? If you can, awesome. I would say go for the 15-year, because you're going to pay that home off much sooner and you're going to pay a lot less in interest. Let's also think about the amortization schedule we showed you before. Remember, we said interest rates are all front loaded. It takes 19 years and 9 months on a 30-year fixed note before you're actually making a principal payment that's higher than your interest payment. That is absolutely crazy. So it takes almost 2/3 of the note to pay off more principal than you're paying towards interest. In fact, at that time, you would have paid $137,000 in principal on your $320,000 note and $357,000 in interest, and you would still owe $183,000 on the home, which is pretty crazy to think about, and some people don't even want to think about them. It's funny, when we go to the closing table with some buyers, they don't even want to look at that amortization schedule because they know, one, maybe they're not going to live in the home for 15 or 30 years, or maybe they know they're going to refinance it multiple times over the next few years, and that changes all of these numbers. So let's look at the amortization schedule on the 15-year note. On the 15-year note, this is why some of the big finance people like Dave Ramsey and stay out of debt people and don't use debt to buy anything, why they really like and they push for the 15-year mortgage. The reason they do that is because, one, the interest rate's cheaper, but two, you're actually going to be paying a much bigger amount towards principal than interest. So in the exact same scenario, when does your principal bypass your interest rate or go higher than what you're paying towards interest? It's at year 2 in 6 months. So if you purchased a home today, you would actually be paying more towards your principal than your interest payment as of October of 26. So that means you would have paid about $166,000 in interest to have that happen. Whereby in the 30-year example that we mentioned before, it was $357,000 in interest. Crazy. Okay, so some of you are probably thinking this, because I know I thought it when I bought my first home, is, well, I'll just get the 30-year mortgage and then take the $625 and put it towards the principal on a principal reduction every single month, which would be awesome if you actually did that. If you were actually diligent and did save the $625 and put it towards principal every single month that you made your normal mortgage payment, you would actually start paying principal payments greater than interest payments exactly 5 years into the loan. And then you would obviously pay off the loan much faster than if you never did this, but you still wouldn't catch the 15-year note. You would actually pay it off in October of 2039. So actually you would be right around, what is that, about a year and a half slower than going the full 15-year route. But by doing this, you gave yourself some flexibility in there where you could actually miss an extra payment here or there if a life change happened, or if your car broke down or a kid went to college, any of those things that could happen over 15 or 30 years from the time that you buy your home. So you can see there's a lot that goes into choosing which kind of loan do you want, and then which kind of loan do you qualify for the home that you want. So what we want to do is get you with a great mortgage professional that can explain all your options, and then we can go out and find a home with you. So if you would, please smash that like button and subscribe to our channel and share this with as many folks as you can so it can help our channel grow, because we actually give you real information of what's happening in our area.